In this tutorial, we will be walking you through how to use the mortgage affordability calculator available at Hauseit.com. If you're not already on the calculator page itself, you can visit the Hauseit website. The spelling is up here. Go to calculators and click on buy and go down to mortgage affordability calculator. While we have this open, it is worth mentioning that there are a number of other calculators that might be helpful. Most importantly is the buyer closing costs calculator. And this is essential when you're considering what you can afford in the city, primarily because your affordability is determined largely in part by how much you have in savings for the down payment, as well as for closing costs. Usually, closing costs need to be paid up front. They can be financed in certain instances, but in general, they are considerations that you would have to essentially pay for without financing as a base case. So the buyer closing cost calculator will give you an estimate of what you would expect in regards to closing costs. Now, it's worth remembering that co-ops and condos have very different closing costs. Co-ops for buyers have much lower closing costs. Assume, say, around 2% for a co-op, and a comparable condominium, if you're financing, would have closing costs for a buyer closer to 4%. So essentially double. So that has an important relevance as it relates to affordability. You need to have an extra, in theory, an extra 2%. So if you're buying a $1 million property and it's a condo, instead of a co-op, you'd need an extra 2% or $20,000 in liquid assets. There are also a number of other calculators. The mansion tax calculator is pretty interesting. It's very detailed, especially if you're buying something above $1 million and particularly above $2 million. And that's because the mansion tax was actually updated in 2019. It was changed from a one tax rate system to 8 different tax brackets. And that starts to have an effect when you're at or above $2 million. So feel free to check that out. There's also a couple other calculators, mortgage recording tax calculator. If you're financing and buying a condo, that's important to think about. And if you're buying an investment property, you may want to look at the cap rate calculator that helps you crunch numbers and come up with essentially the economics of an investment and determine how it compares to other properties you might be considering. So going back to the mortgage affordability calculator, the first thing you want to do is just go ahead and put in your annual income. That's going to be the most important factor in determining what your maximum monthly mortgage payment would be. Now, most banks will lend on average to a maximum of 43% debt to income. And so what that means is no more than 43% of your income can be dedicated to your housing expenses. Now, your housing expenses consist of more than just your mortgage payment, principal and interest. They would also include your home insurance premium, your property taxes, as well as your common charges in the case of a condominium or maintenance in the case of a co-op. So we've put an income here, but this figure is not super accurate because it's not taking into consideration the fact that you will have other housing related expenses. So if we were to take an example, we would go to a listing in the city. Why don't we click on something like this for starters? And we're going to actually look and figure out what the carrying costs are for this property. So in this case, if we scroll down here, we see that the maintenance is $775 and the monthly taxes are 0. Now, if the monthly taxes are 0, it's an immediate indication that the property is a cooperative or a co-op. Co-ops are very different from traditional real property in the sense that the property taxes for a co-op are paid directly by the co-op corporation to the municipality. And therefore, individual owners of co-ops do not have to make payments directly to the Department of Finance. Therefore, if you own a co-op, you only have one payment every month. Essentially, it's called your maintenance, and it does include your share of the building's costs of upkeep as well as your share of the property taxes for the corporation that are being paid on your behalf by the building itself. So if we take the $775 and we go back into the calculator, we can put that here in monthly common charges or maintenance. Now, if you have further questions about common charges and maintenance, or DTI, debt to income ratio, you can actually click these links and it will open up detailed articles which go into further detail about those topics. Now, as you can see, once we added the 775, it has considerably lowered our maximum monthly mortgage payment that we're able to qualify for. So I'm going to remove it again, and you'll see that we went from under $2,000 to more or less $2,700. So let's put in 775 again, and you'll see that it's gone down. So this is a co-op, so there will be no property taxes, so we'll leave that as 0. And then for a home insurance premium, you can estimate this. Typically for your standard apartment in the city, it will be anywhere from $1,000 to $2,000 a year. So a fairly conservative assumption, unless you're buying an ultra high-end property, would be around $100 a month. And again, when we put in that home insurance premium, it's actually reducing ever so slightly the maximum mortgage payment that we can qualify for on a monthly basis. So this is starting to paint a pretty good picture of what you can afford. And then the other thing to consider is your monthly other fixed liabilities. So if you more or less have student loans or other debt, the bank will be incorporating those when it comes to the DTI ratio. So, if you have $100 a month in student loans, you really should put that there. The other thing to consider is the interest rate. We want to put in the interest rate there because that will now start giving us a little more detail. So it'll give us now maximum purchase price, down payment, loan size, so on and so forth. And you can keep the term usually for 30 years because that is the most common term of a loan. And quick note on that, actually, if you're buying a co-op and you're thinking of using an adjustable rate mortgage or having a shorter term, it's very important that you have your buyer agent confirm with management or with the listing agent whether or not the co-op has any restrictions on financing structure. There are some co-ops out there that will not permit anything shorter than 30 years. There are some co-ops that will change the way you would calculate debt to income ratio if you're using an adjustable rate mortgage. Basically, they would make you utilize the maximum theoretical payment under the highest rate under the mortgage when calculating the DTI. And that makes it really hard to qualify. Perhaps now we can talk a little bit about DTI for co-ops. Although most banks will lend at around 43%, a cooperative in the city will customarily like you to have a debt to income ratio of no more than usually 25 or 30%, in some cases 35%. Oftentimes a co-op doesn't actually tell you what their requirements are, and so in those instances it's a bit of a triangulation that has to be coordinated by your buyer agent in terms of speaking with management, speaking with the listing agent, trying to paint a picture of what exactly they're looking for. But in this example, we were presumably targeting a co-op in Park Slope, so we should probably lower this maximum debt to income ratio to something closer to 30%. And you can see what that does. It significantly reduces essentially everything you can afford. So let's go back to 43%. And the purchase price, the maximum purchase price, has gone up by like $170,000. So we'll go back to 30. And then here we want to start figuring out how we can make it work for properties that we're interested in. So let's go ahead and just adjust our income hypothetically. And let's say we make $150. Now in this case, we've put the assumptions for this listing, which is asking $599, and it appears that our maximum purchase price is higher than that asking price. So assuming we have $133,000 in savings, plus around 2% for closing costs, in theory, we can afford that property. Now, if we were to look at another listing and we were to say that let's say the maintenance was $1,500 instead for this same property, you can see that our maximum purchase price is now below the asking price. So we have to figure out a way to make this work. We could possibly increase the down payment. As you can see, that's getting us closer. So in this instance, it looks like we would need to put down probably 35%. to buy this property if the maintenance just happened to be higher than its current one. So this is really how you would play around with it. There is a bit of circular logic here in the sense that, you know, your maximum loan is really based on the carrying costs, but in theory, you're only looking at certain properties with certain carrying costs because you think you can afford it. So there's a lot of different circularity going on here. So the real goal is just to try to manually test for and iterate based on various inputs relating to, you know, the types of properties that are on the market. So we'll do one more example. In this case, let us try and find a condominium instead. So we're gonna take a look, see what we can find. And let's check it out. Okay, so this appears to be a pretty nice property. It's right under $1 million, so there's no mansion tax. That is a very common strategy for sellers in order to maximize demand for the listing. Go below $1 million and hope that it creates a lot of traffic and attention to catapult it above $1 million, as opposed to listing it above $1 million and then everybody who shows up doesn't want to pay the mansion tax, and you get fewer offers, less interest, and you have less leverage as a seller. So in this case, we have maintenance of $257, and we have separate taxes because this is a condo, and as an owner, you have to pay those directly to the Department of Finance. So let's go ahead and put in $257 for common charges, and the property taxes were $53 a month. Now let's assume we still have $150K in income, we have our insurance premium is the same, but because this is a condominium, we don't need to have a low debt to income ratio. So we can go back to 43%. And as far as down payment is concerned, it may be a stretch to assume that we have $500K in down payment. So we could probably reduce this down to even maybe 10%. With a condominium, there's usually no issue with putting down as little as 10%. So in this case, our maximum purchase price is just above $1 million, which means that assuming we have more or less $100K for the down payment, plus closing costs of around 4%. So let's say if we have $140,000 in liquid assets, basically in savings, in theory, we could afford this property. It's also worth mentioning that most lenders require you to have at least 6 months of your monthly housing expenses in reserve assets after closing. So that would mean if your monthly mortgage payment is about $5K, you would add that to the common charges, maintenance, taxes, and home insurance premium. So call it $5,500. They would expect that you have 6 times $5,500 after factoring in your down payment and your closing costs. Oftentimes, if you have that in a 401K or some sort of retirement asset, they will give you partial credit towards the reserve requirement. In some cases, it's 50%. So if you have $200K in a 401K, you will have up to $100K in credit to satisfy your reserve requirements. If you have any questions, leave us a comment right below the video. And don't forget to email yourself the results. You can share them with family members, or you could print out a PDF. If there are any other questions as well, don't hesitate to give us a shout, send us an email. Again, leave a comment, and good luck with your home search.